Good morning, everybody. Today we are going to continue with our session on Forex and we'll do a lot more practice on questions related to the Forex, right? So let me share my screen here. I hope it is visible. We have done in the last session this question. I would like to quickly have a recall of how we can solve these questions quickly. So as we had spoken, first we have to look at what is the currency that we need. So it is Singapore dollars. How many? 25 lakh. And we are an importer customer. So if an importer customer is requiring Singapore dollar to remit, he has to buy Singapore dollar. Required rate would be rupee by Singapore dollar asked. So the very first thing you will quickly calculate is what is the requirement and whether we need the bid or the ask. And here we are given that the bank has given two dates, January 28 and February 4. So we will be calculating what is the impact of delay by the bank in executing the letter of credit. Now, as you can see, cross currency rates would be applicable here. We have got rupee by USD, then we have got USD by pound, and then we have got Singapore dollar by pound. So for ask, we will multiply 45.9, 1.7850 and will divide by 3.1575 as we need to inverse this code and these will remain as it is. So if you will have rupee by dollar multiplied by dollar by pound and multiplied by pound by SDT, you will end up getting your required ask. As dollar and pound will get cancelled. So you will be having rupee by SDT. Now, if you look at the codes given, this is given as it is, this is given as it is, whereas this is given oppositely. So it's a inverse here. We are given STT by GBP, so we will be reversing this code, inversing this code, and therefore this ask will be multiplied by, divided by this bid. So as we inverse the code, 1 upon bid becomes ask and 1 upon ask become bid. So executing the same here, 45.97, 1.775 divided by 3.1380. Finally, as we have a margin also here, we will add the margin because we'll have to pay the margin extra. So you will calculate how much is the loss or gain to the customer because of the delay. Also revising another question, if you look at this one, XYZ Indian company. So here we talked about the options. Now what here you have to see is that you are a first step, you are an Indian firm. Second is you need the Japanese yen to pay. So you need rupee by yen and you need to pay the Japanese yen on 30th June. So you will have to buy the Japanese yen. Once again, ask will be applicable for the code. So this is the spot. Forward rate is given. But here again, what rates are given to you is yen by rupee. So you'll have to inverse the codes. 1 upon 1.9516 would be your spot. And 1 upon 1.9726 would be the forward. So 500,000 divided by 1.9726 is what you have to pay in rupees to buy 500,000 yen after 3 months. Similarly, call option, put option, both are given. Now, what do you need? You need to buy the yen. What is given? The option is given for rupee. So instead of buying yen, you will also say that you are selling rupee. Call option is applicable when you want to buy the currency, and put option is good if you want to sell the currency. So you will be fixing your price that you're going to sell the rupee for 2.125 Japanese yen. However, the premium which you have to pay, that would be your cost. So you'll have to pay addition. Right? I hope you have recalled what we have discussed in last session. Now, I'll give you a few template here if you have questions on money market as well as if you have questions on futures. So how you can execute these questions in simple steps so that you are able to solve it without any error. We did this question also. We will recover it using the template. So ABC Technology is expecting to receive how much? 400,000. When? After 3 months. 400,000 is US dollars. So most important information you capture from here that you have US dollar 400,000 receivable after 3 months. How are you going to hedge this? Using the future contract. So when you have a future contract, you have receivable. So it's an asset. How much is the USD you have receivables? 400,000. Time 3 months. So what is the hedging technique you will use in futures? Since you have USD receivables, you will sell the, when you have receivables, your fear is that the prices may not come down. If you fear that the prices may not fall, that means prices are high today. So you will sell futures so that even if the prices fall down in the future, because you have sold it at a higher price, you will stand to gain. So you will sell the dollar futures. So this is the hedging technique you will use. Now, what is the standard size? That is important. So the standard size for future contract is $1,000. This will tell you what is the number of contracts you have to take. So as on date spot and future dollar contract are quoting at 44 and 45. Standard size is $1,000. Therefore, 400,000 divided by 1,000. This will give you number of contract. Number of contract comes out to be 40. Right? So we'll go very slowly. What is it that we have an asset or a liability? What is the time? How are you going to hedge? So you have to decide whether you will buy or sell futures for that currency. Then you have to find out how many contracts you have to purchase by looking at the standard size. So the total amount when divided by standard size, it tells you that you have to buy these many number of contracts. If they are not in a exact decimal, exact number, whole number, you have to convert the decimal. How much you convert, that depends on you. We have discussed in the last session. If you want to take some risk, you can leave the decimal part as unhedged. But if you want to surely cover the entire amount, you can move to the higher number. Now, then you have to see what is the futures available at. So dollar futures are available at 45. Future is available at rupee 45 per dollar. Sometimes in futures, margins are also taken, but this question does not talk about margins, so let's ignore. Then we have to see when the company is closing the position after 3 months, what is the future quoted at? Now the future is quoted at 44.5. $44.50. So something which you have sold for 45, sold for 45 is now trading at 44.50. You will stand to gain. How much? 50 paisa because the gain is in rupee. So something you sold for 45 is now being available at 44.5. So you will stand to gain. 45 minus 44.5, 50 paisa per dollar into how many dollars? 40 contracts of $1,000 each. So the total gain becomes 200,000. But this gain is in rupees. So what will happen after you have received the dollars? Dollars will actually be sold in the spot market only. What is the spot quoted at? 44.5. So total inflow would be 400,000 into 44.50, plus there is a gain on future. So it will be 200,000. And if there is any interest cost, if you have given any margin, that will also be adjusted. So this will become your net inflow. 400,000 multiplied by 44.5, which is equal to 1 crore 78 lakhs. And plus you have a gain of 2 lakhs, no interest cost. So net inflow here will become 1 crores. Okay. So this is the inflow you have from by using futures. So you can take care, you can use this template for all the questions. If you will do questions slowly on futures, absolutely there will not be any problem, right? So use this template in further questions also that we are going to do today. Now, we also did this question where we talked about money market hedge. Columbus Surgical was having some surgical raw materials imported from UK, which was invoiced in pounds. And there was an Indian customer and a French customer who were invoiced in pounds as well as in euro. So 480,000 was the payables and 138,000 and 590,000 euros were the receivables. So similarly, you can use either the forward market or you can use the money market instruments. How you use the money market hedge? By looking at the rate of interest available in the different countries. So in UK, France, USA. Now, as exactly after 3 months, we have 480,000 pounds payable, but we also have 138,000 pounds receivable. So if you apply the concept of netting, you don't need to worry about the 138,000 pounds. You will receive from an Indian customer and you can easily make the payment to the UK customer in the pounds. However, the amount is not completely settled. So 480 minus 138, the balance amount you should hedge using money market hedge. So as you have payables in pounds, you should ensure that exactly after 3 months, you should have pounds receivables. Similarly, the French customer will pay after 4 months. So we need to hedge using money market instrument. $480 minus 138. 342,000 pounds receivables are to be hedged. Sorry, payables are to be hedged. With the UKs, we have the relation of a importer. So we have to pay. And we have euros 590. This is your receivables. So first you have to see how much are you going to hedge. This is the payables, this is the receivable. First step. Second step, look at the time period. For pounds, it is 3 months. And for euros, it is 4 months. Then you have to see what you have to create. So for payables, you have to create a situation where you receive exactly that much pounds. So if you have to create a situation of receivable, that means you have to invest. And for receivables, you have to create an opposite situation. So create a situation where you have to pay. So you have exactly 590,000 euros payable after 4 months. So for making a payable, you borrow. Once you have calculated the third step, whether you have to create a receivable or a payable, next step is not exactly 590 you have to invest, not exactly 342 you have to invest or 590 you have to borrow. You have to borrow or invest their present values of the amount. So next step is to calculate the present value. So if you have to invest 342,000 receivables, you have to create after 3 months. So don't have to invest exactly 342. You will invest in which country? Pound. So you will invest in UK and investment will give you a return of 10%. So you will invest 342, the present value of 342,000 after 3 months at 10% per annum. So for 3 months, the rate of interest becomes 1/4 of 10%, 2.5%. So 342 divided by 1.025. Now, if you need these many pounds today, how will you get them? Use the current exchange rate, spot exchange rate, to convert using your US dollar. So you will know exactly how much will be the amount you have to invest today. And similarly, for the euros which you will receive, you have to create a payables in euros. Euro, we can take France as a replication of euro country. So here you have to borrow. Borrowing will be available at a higher rate. Now this is for 4 months. So you will calculate 16 divided by 4 by 12, the rate applicable. That much is what you have to borrow. So if you have to borrow that, you will get it converted into US dollars and invest in US. So once again, for investing in US, you will get this is the investment rate and this is the borrowing rate. The higher will be the borrowing rates and the lower would be the investment rates, right? So I hope you remember this is what we have done in the last session. So this is how you will create a template for the money market instruments. Simply, you will recall what is your asset. So for example, if you have pounds payable, so you can say that you have pounds payable, how many? 480 minus 138, 342. So it's a liability because it is a payable. So create opposite receivables. Now, if you want to receive exactly after 3 months, if you want to receive this money, you will have to invest. So either you say lend or invest. Where? How much? The present value. Okay. So you will invest the present value of 342,000. Where will you invest? You will have to invest in UK. The applicable rate in UK for investment is 10% per annum. Now, 3 months means equivalent to 2.5% per quarter. So 3,42,000 will be divided by 1.025. Okay. You will calculate this figure. How much is the amount which is required to be invested? So this comes out to be 342,000 divided by 1.025. So 333,659 is what you will invest. Now, how will you get these pounds? You don't have, you are in US person. So you will first convert your dollars into pounds. 333,659. You can round off here, okay? So these many pounds you no need. So you will use the current spot rate to make the investment. What is the spot rate against pounds? This is the spot rate. What is it? 1 pound is for US dollar 0.9830 and 0.9850. Now, because you have to borrow this amount, you don't have it, you will borrow it in the US market, and therefore you need to have pounds. So pound ask rate would be applicable. Spot rate, pound dollar by pound ask rate. But once again, the rates available to us are pound by dollar. So therefore, we will have to inverse the rates, divide by 0.9830, right? So this divide by, and this will give you how many dollars you will need to borrow today so that you can invest in the UK market. US market has a borrowing rate of 13%. So you will end up paying whatever the amount you borrow, you will ultimately end up paying these many dollars together with interest of 13% in the US. 13 divided by 4, that means you will end up paying 3.25% interest. So 1.0325 33659 33659 divide by 0.9830. You need to borrow 339429, or you can say 30. And when you will repay 3,39,430 together with interest, your net outflow after 3 months would be 350,461 or 62. Now, how money market hedge has worked? We had a liability to pay 3,42,000. So no matter what is the exchange rate, it will not matter to us. We had converted our liability in a foreign currency into a liability into our home currency. How? Because what will happen is Whatever the payables are, you create exactly same receivables in the same currency. So if you have to create receivables, you need to make an investment in that currency today. But you will not invest exactly 342,000. You will invest the present value of 342,000. But you don't have these many euros or pounds to make an investment. So for that, you will have to borrow this much amount in US dollars today from your home country. So if you need 333,659 pounds, you have to borrow that much amount in US currency. So first find out that is equivalent to how much US currency. So at using the spot rate, you have to borrow 339,430 pounds dollars in the US. So if you borrow 3,39,430 dollars in US today, convert it into pounds, invest in UK, and then get it, receive it exactly after 3 months as 342. So this will ensure that your dollar outflow will be 350,462. This is what you have fixed. You have hedged your exposure. No matter what is the spot rate after 3 months for dollar to pound, your outflow in terms of your home currency will remain 350,462 no matter what is the exchange rate. So you have fixed the outflow in terms of your home currency after 3 months. So what is the flow? You have payables in pound, create receivables in pounds, exactly same amount. How can you create receivables? By investing the present value in UK. So lending rates would be applicable, right? After this, convert the present value into home currency, because where will you get money to invest this pounds? You will borrow it in your home currency. So first convert it into the home currency using spot rates, and borrow that amount in your home country. So when you are borrowing a higher rate, borrowing rates would be applicable. So you will borrow these many dollars today in the US market. Applicable rate would be 13%. This you will end up convert it into pounds, invest in pounds, and after 3 months you will have exactly 342,000 pounds receivable, which you can use to settle your liability to make the payment to the UK exporter or from whom you have imported the goods. So this will be applicable, and your dollar outflow will simply be the current amount which you have borrowed together with the interest. So irrespective of what is the exchange rate, exactly after 3 months, you will have to pay only $350,462 to be able to make the payment to the UK person from whom you have imported. Similarly, in this question, we also have receivables in euros. from the French customer after 4 months. So for that, we will say that we have an asset of euro. We will create a liability. We will create payables. If you want to create payables, you will borrow in euros today, but you will not borrow the entire amount. You will borrow only the present value of 590,000 in francs. So that is at 6%. You will calculate what is the present value of 590,000 at 16% for 4 months. Now, if you want to borrow that much amount in euros, you will convert the received euros into dollars, and that dollar will be then invested in US, your home country. So you will invest that much amount in US at 11.5% for 4 months. So after exactly 4 months, you will have this much inflow, no matter what is the price of your euros. Whatever you have invested in euros, that will, whatever you have taken the loan, you will receive from the French customer the euros, and you will exactly pay the same amount to the person from whom you have borrowed in France. Right? So let's do a few more questions. Once again, calculating this, and here we will talk about. So now you understand very well what is the forward market, what is the money market, and what is an option contract, and also what will happen if you remain unhedged and if there is no hedging. Let's look at this question. XYZ Limited is a US firm. So my first important information comes from here that the firm is USA. So therefore, home currency will become dollars. This company will need 3 lakh pounds in 180 days. So it will need means it has payables. Exposure is what? You have payables. Pound 300,000. Payables. So there is a liability to make a payment when exactly after 180 days. The following information is available. 1 pound is $2. Now in this question, there is no bid asked. So you don't have to worry about what will be applicable. So spot is 2. Indirectly, this is clear that if we want to make the payment right away, we would need 300,000 into 2, $6 lakh. But after 180 days, the exchange rate will become forward rate is given. So your A part is given. If you go for a forward hedge, the forward rate applicable is so the outflow after 180 days will be 300,000 or 3 lakhs into 1.96. You can simultaneously use calculators to figure out the answers. So we have $588,000 payables. So this is if you go by a forward contract. Interest rates are also given, and call option is also available on pounds. So that means if you want to buy or sell a call pound, you have to see a call option or a put option. Now here, as your exposure is payables, for call options you will see. How will you figure out what is applicable for an option? First, you have payables in pounds. So you need to buy pounds. And when you want to buy some underlying asset, you generally be a holder of call option. So you have to become a call option buyer. If you are a call option buyer on pounds, so the option should be on pounds. Option should not be on dollars. Option should be on pounds. So call option is on pounds, and this is pounds which you have to buy. So you will buy a call option of pounds. At what price is it available? At 1.97. So if you exercise the call option, then definitely you will end up paying $1.97 per pound to be able to make the payment of 300,000 pounds. So if you go for a call option, pounds are available at a strike price of 300,000 into 1.97. Your outflow in terms of exercising the call would definitely be 5,91,000. A little more than forward, plus there would also be some premium. Now, calls are exercised only when the market price is more than the exercise price. So if your dollar pound spot rate after 180 days will exceed 1.97, the call option will be exercised. Right? So the pound starts being available for 1.98, 1.99, 2.0, 2.01. That means they have become expensive, but because we have already taken a call option, we have the right to exercise this call option after 180 days, and we will be able to get our pounds for 1.97. However, if in the market the price of dollar to pound is less than 1.97, we'll let the call option lapse and will not exercise the call option. We will buy our pounds from the market itself. And what is the premium that is payable? 0.04. So you can be assured that if call option becomes exercisable, $1.97 per pound plus 0.04 premium. So you will definitely end up paying $2.01 per pound. Which means 3 lakhs into 2.01, and this makes 6,03,000 pounds you will have to pay. And we have also been given the forecast of spot rates 180 days from now onwards. So what will be the spot rate? That can also be calculated using the expected value. So the question that is being asked to you, which of the following strategies is most preferable? A forward contract, a money market hedge, an option contract, or no hedging, right? So far, we have calculated our first answer that if it is a forward contract, the outflow will be $5,88,000. Now, for option also, we have done a little working that if we have figured out that we will need to buy a option on pounds. So we will buy a call option on pounds, and which will be exercisable if the price exceeds 1.97. And in that case, if call option is exercised, then the outflow will be $2.01 per pound. So the total outflow would be 300,000 into 2.01. So 6,03,000 would be the outflow. But we are not sure after 3 months, after 180 days, sorry, what would be the spot rate. So here in this question, probabilities are given and three rates are given: 1.91, 1.95, and 2.05. So we will see what are the possible spot rates. Possible spot rates are 1.91, 1.95, and 2.05. With the probability of 25%, 60%, and 15%. So for probability, we can write 0.25, 0.60, and 0.15. For hedging, what the person has done, he has bought a call option on pounds at a strike price. You can write complete in the exam, or if you're writing for the first time X, you have to say that X, which denotes the strike price. $1.97, and paid a premium of $0.04. Okay. So like we said earlier, call options are exercised only when the price will exceed 1.97. So here it is below 1.97. Here it is below, expected to be below 1.97. But here it is going to cross 1.97. So check out whether the call option will be exercised or not. Here the call option will not be exercised. No, no. But here the call option will be exercised. So if the call option is not exercised, the price at which the dollars are available to you is 1.91, 1.95, but here they are available for 2.0. We'll ignore the premium here. $1.97. But we have also paid a premium of some amount. What is the premium? $0.04. Premium is also in dollars, 0.04. Premium will remain same irrespective of whether the call is exercised or not. So net, it will cost us 1.95 here, 1.99 and 1.2.01. Now, what is the payment then you will have to make? This is the rate which will be effective. So 1.95 into 300,000. If it is a CIS scenario, the outflow will be 5,85,000. If it is second scenario, the outflow would be 1.99 into 300,000, which is 5,97,000. And if the exchange rate applicable turns out to be net 2.01 because the call option is exercised, then 2.01 into 3 lakhs that we have already calculated also, but because there are three probabilities of three possible rates, the net outflow in option, we cannot say that option will cost us 603. Option will cost us 6,03,000 only if the call option is exercised. But that has a very little probability of 0.15. So we need to calculate the expected outflow if hedging is done using option. So expected outflow would be summation XIPI. So these are your possible probabilities of outflow. And these are your outflows under the three scenarios. So the expected value will be 5,85,000 multiplied by 0.25 plus 5,97,000 multiplied by the respective probability 0.60 plus 6,03,000 multiplied by the respective probability of 0.15. So when you will calculate these figures using your calculators, the outflow will be 146,250 expected value of outflow in the first scenario. The expected value of the outflow in the second scenario is 3,58,200 and the expected outflow in the case of third scenario 6,03,000 into 0.15 is 90,450. So the expected outflow will be, when you will add the three figures, 5,94,900. Okay. So we did have 603, but the probability of 603 was only 15%. So using probabilities, expected outflow is not 603, but 594,900. Now, if you compare 594,900 with the outflow that was there in the forward plan. So under forward hedge, it was 588,000. but under the options, it is 594,900. As we have payables, the lesser, the better. So forward is better than the option so far. 594,900 is more than 588,000. Therefore, forward contract is giving us a better answer than under the option contract. Now let's look at the money market hedge. For money market hedge, we need to have the interest rates applicable in the two countries, which is US and UK. So instead of writing 4.5/5, here the deposit or borrowing rates are given. You can call it deposit, lending, or investment. So if you have to make an investment, you have to lend, or if you have to deposit, it's 4.5 in UK. But if you have to borrow in UK, then it is 5%. Similarly, if the deposit is to be done in US, you would get 5%. But if you are borrowing in US, then you will have to pay 5.5%. These rates are annual. So you have to calculate 180 days deposit rate. So you will calculate it for 180 days. We have already seen how the money market hedge works. Let's look at it. So first, we have a liability. What is the liability? We have 300,000 pounds payables. So we create an asset opposite. So create an asset, that means invest in pounds for 180 days. That means the deposit rate in UK will be applicable. So you will lend or borrow, or lend, or you can also call it deposit. So lend or deposit in UK 100 for 180 days. The present value. Okay. So in this step, we will calculate the present value. What is the deposit rate in UK? 4.5% per annum. So for 180 days, if you are depositing the money, you need to deposit the present value of 300,000 divided by 1.0225. Okay. You can calculate this number for 1.0225 by simply straight away dividing 4.5 divided by 200 plus 1. Why I'm dividing by 200? Because if I assume 360 days in a year, 4.5% is for 360 days. So 180 days is 6 months, or exactly half. So when you have to calculate the annual rate semi-annually, you can divide by 200. If you have to calculate by for quarterly, divide by 400. If you have to calculate it monthly, simply divide the percentage by 1200 and add 1. So you get the fraction very quickly in this manner. So how much pounds do you need to invest? 300,000 divided by 1.0225. That means you need to invest 293,399 pounds. Once again, you will remember to mention in your answer that you have rounded off till what digits. Now, you don't have 293,399 pounds to invest right away, right? So where will the money come from? You will borrow in US market using the pound and dollar exchange rate spot. Okay. So what do you need today? You need 293,399 pounds. Where will they come from? You will have to buy the 293,399 pounds in US market. What is the current exchange rate? £1 is available for $2. Dollar by pound ask. Ask is not given as such. One rate is given. Current exchange rate is 2. So 293,399 into 2. You will need to borrow dollars 586,798. So borrow 586,798 dollars. In US market, and in US market the borrowing rate is 5.5%. So this is what you have created the scenario today. What will happen exactly after 180 days? What is that you have done? You will repay the dollar amount together with interest. So repay 586,798 together with interest at the rate of 5.5%. So how are we going to solve 5.5? 5.5 divided by 200 plus 1. 1.0275. I do understand that we can have a very good mental calculation and we can do it without using our calculators. But in exam time, I just suggest, even if you have calculated it mentally, please use your calculators as well. Verify your answers if you have calculated manually. So this is what is going to be your outflow. I can round it off once again. So 6,02,935 is going to be your outflow if you go by money market, right? So how does money market hedge works here? You had 300,000 pounds payable. So create a situation that you have exactly 300,000 pounds receivables after 180 days. So if you want to receive, you have to make an investment today. What is the deposit rate applicable in UK? 4.5%. So how much you will deposit today? You need 300,000 after 180 days. So invest present value of 300,000 using 4.5%. So you need to invest $293,399. How will you get this dollar? How will you get the pounds 293,399? That you will have to convert it into US dollar in using the spot rate. So for getting 293,399 pounds, you need 586,798 dollars. Where do you have this money? 586,798. You don't have it, so borrow it in the US market at 5.5. This is what you have created a hedge today. This by using these actions of yours. What after 180 days? After 180 days, you will exactly repay the loan at 5.5% in the US market rate. So you will have an outflow of 602,935. And as you have invested in investment in US, investment in UK will release 300,000 pounds used to make the payment. So whatever you had to make the payment to the UK exporter, pound 300,000, whatever you need, you have received it. Your requirement is fulfilled because your investment in UK will give you 300,000 pounds. And you will repay the dollar loan in US. So net outflow will be in your home currency, which is dollar 602,935. Okay. So if you use a money market hedge, it is 602,935. So we have got the answer for three scenarios. Forward contract outflow will be 588,000. Money market hedge, the outflow will be 6,02,935. And in the option contract, as such, the outflow would be 6,03,000. But when we are calculating the expected value, it is 594,900. So far, we are best under the forward contract. Now, let's see, there is one more option here, no hedging. So whenever there is no hedging, that means you've not taken a forward contract, you have not gone to a money market hedge, and neither you are using an option contract. So when you are not hedging, what you do is simply use the expected rate, which will be there after 180 days. Now that might generally be given in the question. However, here we are not given the rate. We are given three possible scenarios. Yes?
We are given here 180 days deposit rate and 180 days borrowing rate, and we have taken it at half of it.
Okay.
So our
Uh,
calculation will be go wrong now. It's given and one not yearly annual basis. It's on
okay.
180 days basis.
Here there are two possibilities. One is the 180 days deposit rate could be given as 4.5%, like you are saying. So you are assuming that if you deposit for 180 days, you will get exactly 4.5%.
Yeah,
But
man.
actually what happens is there is a reset dates also. Like it's reset after 6 months. Okay. So annual rates are reset after 6 months. So 6 months, lending rates are 3%. 6 months borrowing rates are 4%. That means that the rates which are applicable now and the reset period is after exactly 6 months. Okay, I'll explain to you. You must have come across the term LIBOR, which is London Interbank Offer Rate. Okay, now if I say 6 months LIBOR is 5%, this does not mean that the rates are for 6 months, that you get five
Okay,
percent
ma'am,
in
I
six
understood.
months.
I understood. That's it's 5% annual, but it's for only the six
It's
months for the time period
that
of six
that is
months.
huh,
After that, it will reset or
it will reset. Right,
some other
right,
circular will come. Then it will be downgrade upgrade
right. So 180 days at present, the rates which are applicable for annual deposit
for the
and lending
current six
rates
months. Okay.
reset for next 180 days. That is going on is this. Okay,
And as current we have taken it 4.5, and on that we have taken 180 days, so we have half.
right. Okay.
Okay.
No confusion now?
No confusion, ma'am.
If you find any such confusion in exam, please make an assumption. If you're still not sure, if you think there is an ambiguity in what you're doing, you can make an assumption.
Okay, ma'am.
On what assumptions you've solved the question. Okay?
Okay, ma'am.
Just in case when you are not sure. But if your concepts are clear, you will be sure, almost sure how to do the question, what rates to use. But if there is ever any confusion, you may make an assumption. You please write down your assumptions while solving the questions. Okay?
Okay, ma'am.
Right. So this is the outflow if you are using an option contract. This is the outflow if you are using a money market hedge. This is the outflow if you are using a forward contract. The term I'm using is outflow because you had pounds payables, which is an indicative that we will pick up the one which is least. Had it been receivables, so far for us, money market hedge would have been the working the best. All right. The last part, no hedging. So if there is no hedging, we simply use the expected spot rate after 180 days. And basis that, we calculate our outflow in dollars. However, the expected spot rate is not given, which again we will have to calculate in this question. So, small part is also left here. The fourth part
Ma'am, for the fourth case, we will take directly the spot rate if given, and here it start given. Then we will take the average of
expected.
what's the
Right,
forecasted
right,
probability along with the
right. So, expected spot rates 1.91 with a probability of 0.25,
2.5, 0.25,
1.95
0.6%,
and 2.05.
0.15.
So expected spot rate using the same formula, summation XIPI, where X is this and probabilities are here. So expected spot rate will be 1.91 multiplied by 0.25 plus 1.95 multiplied by 0.60 plus 2.05 multiplied by 0.15.
Comes out to be 1.955.
Comes out to be,
1.955.
I will accept your answer. I'm not verifying. 1.955.
Yes, ma'am.
Let's round it off till three decimals. Make this assumption here. Make a note that we're rounding off the expected rate till three decimal points. But generally, you must round it off only till two as your rates are given here 1.91, 1.91. So since the PIP rate or the forward points, etc., are mentioned here, that means your currency exchange rate should be in decimals of two. So maybe we can take 1.96 also here, right? That would be a better assumption. So 1.96 is your expected rate if no hedging is done. Then 300,000 multiplied by 1.9. That comes out to be exactly the forward rate. So if you use the 1.955 here, then mentioning that you are using calculations till two decimal points, three decimal points, sorry, the outflow would be 586,500. Okay.
Yes, ma'am.
Now you will also be asked to recommend here. So first you have shown your calculations forward options. B will be money market, sorry. C is your options. And D would be if no hedging is done. So you have presented your solution A, this is C, and this is D. Finally, you will also be asked to give a recommendation. So when you're giving a recommendation, you please summarize your solution that these were our options. We could have gone for a forward contract. We could have gone for a money market hedge. We could have used an option contract. And finally, we could have gone for no hedging. Now, generally, it's very easy to pinpoint or say that since the outflow is least if we do not hedge, okay,
Yes, ma'am.
therefore, that is coming out to be the best answer, least outflow, therefore, this is the best. But do mention a caveat or a disclaimer here or a point here that, however, no hedging also means there will be some risk, right? So, because here I don't see any significant difference in no hedging or forward. And even if I had seen a significant difference, I would still have recommended a forward contract would be a best option. And though if you do not hedge, the outflow is least. But if the investor is risk taking, he may go ahead with no hedging. However, it is recommended to go for a forward contract. Okay. So if you are saying you have two options, if you are taking some risk, no hedging. If you are not taking risk, forward contract. These are the two options. So leave both the options there, mentioning that depends upon the investor. If he is a very risk averse person, he should definitely go for the forward contract. Particularly in this scenario, as risk taking person will also go for a forward contract only because there's no significant difference in the outflow, right? Very little benefit it might be there, but that would be a very high risk. Clear? Even a risk taking person will always compare the benefit of taking the risk. So the benefit of taking the risk is not significant in the outcomes under the four options. Understood? Everyone, right? So look at this question, which is talking about the three types of hedge here: forward contract, money market, option. Here, a future was missing, but instead of future, it was no hedging. So when an exam question comes, they could be forward, money market, option, and future. You must be quickly be able to solve all these parts so that you don't waste much time in doing these questions. So you should have absolutely clear thoughts on what you are supposed to do. So very importantly, I'll quickly recap. Your first step should be take time to understand that whether you are which country native, which is your home country. So you would want a final answer to be an outflow or inflow in that currency only, right? So a US person would like to see how much is the outflow because he needs pounds 300,000. So what would be the outflow in terms of dollars to be able to make a payment of 300,000 after 180 days, right? Spot rates would always be given. Forward rates would be given generally. Future expected spot rate after 180 days could be directly given or could be given in terms of probability. So if it is given in terms of probability, you'll have to make a calculation. One more very important thing. While doing an option contract, you cannot say that the expected rate is 1.96 as we have calculated here, 1.955. Therefore, the option will not be exercisable. You cannot just compare with 1.955 with 1.97. Okay, that would be a mistake. Otherwise, why are we doing an option? If we are supposed to calculate a 1.955 expected rate, We cannot decide whether the option will be exercisable basis on this. So as three scenarios are given, we are very clear that the option will not be exercisable in the first case. It will not be exercised in the second case. It will be exercisable only in the third case. So there is a difference when you are using the three rates and probability of that possible three rates under an option contract. And there is a difference between when you're calculating the expected rates using those probabilities. Option question cannot be solved directly by comparing 1.97 exercise price with 1.955. Is it clear?
Clear, ma'am.
Right. All right. Let's look at this one more question. There is an American firm. So how we proceed with the question? That for me, the direct current quote will be dollar by any foreign currency. And I will be interested in finding out my final answers is dollars, whether it is inflow or whether it is outflow. So I am interested in finding out whatever the inflow or outflow is in terms of USD. So he's under obligation to pay interest of Canadian dollar 10,10,000 and Canadian dollar 7,05,000 on two different dates, 31st July and 30th September, respectively. So my first I've started working in my mind that we have Canadian dollars payables. Okay. So we need to pay Canadian dollars. So we should have dollar by Canadian dollar asked. But there are two different amounts and on two different dates. So now I know that we are to calculate something on 31st July and then on 30th September. Where am I? Am I on 1st April or what? It's not given. So I would be interested in knowing what are the rates applicable for 31st July and 30th September instead of 3 months, 4 months, 6 months. I don't know. Now the firm is risk averse. This is a very important thing. The firm is risk averse. So if this line would have been mentioned in the previous question, no hedging would not have been option for us, no matter how effective or how much gain it might give us. But no, the person is or the firm is risk averse. So we are definitely going to hedge. So it is the possibility to cover all the risk which are involved in foreign currency transaction. So it will not leave itself exposed to foreign currency fluctuations of Canadian dollar and in US dollars. So the finance manager of the firm is thinking of hedging the risk, and there are two methods, either forward or option. By now, I'm sure the forward rates is very direct, very simple calculation. So generally in exam, you will have one of the options as forward. Now here the rates quoted are spot, 1 month, 3 months. So this makes me to understand to some extent that I'm on 1st July. Okay.
It's
Because
given in fourth line na ki we are on June 30.
30th June, it's now June 30th or 1st July. Even if it is not given, this is clear from here. Okay.
Okay.
It is given here, 30th July or 1st July. So that's what I'm saying. Even if it was not given, after reading these quotes, it makes me understand where am I standing today, 30th June. Okay.
Okay, ma'am.
Following quotations regarding rates of exchange, US dollar per Canadian dollar. US dollar per Canadian dollar. So what rates are given? USD, US dollar upon Canadian dollar. So this is what we were interested in, and that is what has been given to us. However, it's no ask or bid. So we are given just single. Yeah, the ask and bid are given here. 0.9284, 0.9288. But however, for the forward contracts, the rate applicable is ask for us. So the ask is only given. Okay. So if it is saying 1 month forward is 0.9501, 3 months forward is 0.9556, that means for us exactly the ask is given. However, in the spot, bid and ask both are given. So if we were supposed to be making the payment of Canadian dollars today, it would have been simple. 10 lakh 10,000 into 0.9288. Okay. Similarly, 7 lakh 5,000 into 0.9288. But the rates given to us are 1 month forward. So we can, first step, we will calculate under the forward contract. 10 lakh 10,000 into 9501 is what we have to pay after 1 month. And 7 lakh 5,000 into 0.9556 is what we have to pay after 3 months. Okay. The price of the Canadian dollar option on a US stock exchange, cents per Canadian dollar payable on purchase of the option. Contract size Canadian dollar 50,000 are as follows. So this is the contract size. This is important even under a option contract, which means 10 lakh 10,000 when divided by 50,000, you will not be able to cover 100%. Some portion will remain unhedged. Now, if you divide 10 lakh 10,000 by 50,000, 10 lakh 10,000 divide by 50,000, it's 20.2 contracts. So he's saying the person is risk averse. So here we will take one thing. We will take 20 contracts for 1st July, but for 0.2 contracts also, which is unhedged, we cannot leave it unhedged, as this word is very important that the firm is risk averse. So 0.2 portion we will cover using the forward contract. As you know that forward contracts do not have a standardized contract size. Okay. Team, we will discuss this question after our 10 minutes break, but I'm giving you the insights here because it's a lengthy question, but I'm giving you the insights here so you can think about it and then we will proceed after the break. Okay. So we have call options also, put options also for July also and for September also. And there are three different strike prices, 0.93, 0.94, 0.95. And what is the premium payable? So if you look at the premium payable price for a Canadian dollar option on US stock exchange is these many cents per Canadian dollar. So these cents are given in US dollars. Okay. Contract size 50,000. 0.93, 94, 95. You will choose from these options. You will also choose for calls. You will choose for puts. So you have to decide when you want to buy a Canadian dollar, do you want to go for a call option or a put option? Now let's read the question further. According to the suggestion of the finance manager, if options are to be used, 1 month option should be bought at a strike price of 94 cents and 3 months should be bought at a strike price of 95 cents. So the three rates that are given that are not relevant because we have been specifically given that the 1 month option will be exercised for July would be exercised for 0.94 and September would be for 95. Okay. This is clearly mentioned. The remainder will be uncovered by the options. The firm would bear the risk itself. So, okay. Had the word been risk averse, we would have gone for a forward contract. But
However, but
the
it's given that the uncovered.
finance manager, as per finance manager, the remainder remains uncovered. Okay.
Then we will not go for my forward
Forward.
contracts. But
But
the
then for this, it would use forward as the best estimate of the spot.
Ma'am, and for also the strike price 94 and 95 given, we will first calculate on the basis of the 1 month forward and rate at a spot rate covered. Then we will differentiate
Yeah.
with 94 and 95. No,
Uh, Come again, please.
I just want to say that the as per the finance manager, it's 94% for 1 month and 95% for 3 months. First, we will calculate using the 1 month and 3 month forward rate as given, and then we will compare with the 94 and 95. No, or we will take directly
Yeah.
94 or 95 as.
No. Under the forward contract, we will go by 10 lakh 10,000 into 0.9501 and 7 lakh 5,000 into 9556. That is the final payment which we will be making if we are using forward contracts, right?
Okay,
But
ma'am.
if we are using option contract, for 1 month, we will go by a strike price of 94 cents. For 3 months, we will go by a strike price of 95 cents. And as the finance manager is saying, we can leave it uncovered. However, you cannot then compare outflow for 10 lakh 10,000 Canadian dollars against 10 lakh Canadian dollars, right? So
Yes.
for the uncovered portion, point two or the 10,000 Canadian dollar, we will assume that the expected spot rate is 0.9501 after 1 month. And on 30th September, the expected spot rate for the 5,000 which will remain uncovered is 0.9556. Okay.
Okay, ma'am.
Transaction costs are ignored. So recommend which of the two methods will be appropriate for the American firm to hedge the foreign exchange risk on the two contract payments. Okay. So I have explained the question to you. After the break, when you come back, we will solve this, right? So you can go for your 10 minutes break, right? Thank you. Let's discuss this question once again. Now, American firm is under an obligation to pay interest of Canadian dollars 10 lakh 10,000 and Canadian dollars 7 lakh 5,000. There are two dates, 31st July and 30th September. Firm is risk averse. It will hedge the risk involved in all foreign currency transactions. Finance manager of the firm is thinking of hedging the risk. Two methods, fixed forwards and option. It is now 30th June and the quotations regarding exchange rates are given as under. Spot, 1 month forward, 3 months. So for the July, 1 month forward rate would be applicable. For the 30th September payment, 3 months forward rate would be applicable if we are going by the fixed forward. However, the price for the Canadian dollar option. Now, like we said, we are an American firm. We want a direct quote in terms of Canadian dollar. So we are interested in USD and divide by Canadian dollar. Secondly, we need to pay Canadian dollar. So we want the ask. So we are in need of buying Canadian dollar. That means if you are interested in buying some underlying asset, you will go for a call option of that. So we will use the call options. July and September. Three rates are given, but the question has been very specific that you will use the July call for 94 cents and the September call for 95 cents. So July call is for 94 cents strike price and September call is for 95. Okay. So it's calls 0.94 and 0.9. Then the contracts, option contracts have a standard size of 50,000, which means 10 lakh 10,000 and 7 lakh 5,000 will not be 100% covered using the option. For that, it is said that whatever the uncovered portion is, you will leave it uncovered. However, outflow will be there in the spot market. That outflow in the spot would be considered at a forward rate which is applicable. That is considered as the best. Transaction costs are ignored. However, you can't ignore this 1.02 and 0.6. Right? Why? This is the option premium. So strike price is this. Calls are available at this premium and puts are available at the following. Further, the price for a Canadian dollar option. So that means these figures are or option price. Option price or option. Why do we have a not applicable? Not available. Okay. Not available here. Now, further, what you will see here is we need a call option because we need to buy the Canadian. There is one more thing which we can do. However, will not speculate there at present. So let's start solving this question. So 0.9501 and 0.9556. As the question is for July 31st and September 30th, as well as we have Canadian dollars payables. It's 10 lakh 10,000 here and 7 lakh 5,000 here. Forward rate applicable are two different rates. One month 0.9501, 3 months 0.955. The rates given are dollar by Canadian dollar. That is what we are looking forward. So outflow in terms of dollar currency, simple calculation, 10 lakh 10,000 multiplied by 0.950 and 7 lakh 5,000 multiplied by 0.955. When you calculate, the output will be 9,59,601 dollars on 31st July and 7 lakh 5,000 multiplied by 0.9556. Which currency is at premium? So this is the outflow in terms of dollar. What are the rates given? Dollar by Canadian dollar. Has it increased? Yes. Which currency is in the denominator? Canadian dollar. So Canadian dollar is at premium. If you have any confusion, multiply 705 with 0.9501. How much is the outflow? 6,69,820. Now how much is the outflow? 673. So your outflow has increased. If the same 7 lakh 5,000 were payable on 31st July, you would have paid 669. But on 30th September, you're making a payment of 6,73,698, which means the Canadian dollar is at premium. Now looking at the option contract, the second part. Here we will again divide the calculation into two parts. One would be for July 31st and the other would be for September 30th. Now here, because I would like to use this particular column for information like how much is the unhedged amount, how many number of contracts I'm going to buy, so on. So I would rather divide this particular uh, column into two smaller segments. Let's say one is for USD and one is in terms of Canadian dollars. Or rather, I would put Canadian dollars here and US dollars. Similarly, the 30th September will also be how much Canadian dollars you have to pay and how much US dollars is the outflow for that. So firstly, on 30th, 1st July, the payables are 10 lakh 10,000 and here the payables are 7 lakh 5. Number of contracts, amount divided by contract size. So this becomes 10 lakh 10,000 divided by 50,000 and 7,05,000 divided by 50. This I think we calculated 20.20, and 7,05,000 divided by 50,000 will give you 14.17. So number of contracts, option contracts taken would here be 20 and 14. Amount covered under option would be 10 lakh, and here the amount covered would be 7 lakh. Strike price 0.94, specifically mentioned, and 0.95. So 10 lakh into 0.94 can show the calculation. In under USD, the outflow would be 9,40,000. And for 7 lakh at the rate of strike rate of 0.95, the outflow would be 6,65,000. So 7 lakh multiplied by 0.95. 10 lakh multiplied by 0.94 strike. Okay. However, you will be also paying a option premium, right? How much was the option premium? For the July, it is 1.02, and for September calls, it is 0.65. Okay, 1.64, sorry. So calls are taken for July 0.94. Therefore, the call premium is 1.02, and for September, it is 0.95 cents. The call premium for that is 1.64. So price for a Canadian dollar option on a US stock exchange, how many cents you have to pay per Canadian dollar, payable on purchase of the option, contract size 50,000. Okay. So this will be our option premium, 0.65 and 1.64. So how many contracts we are purchasing for the July? 20 contracts, 20 contracts for 1.02. Okay. These you will pay in directly in US dollars. Okay. And finally, there would be some portion unhedged also. So how much was the unhedged portion? Let's first calculate for the hedge fund. First, let's write for the unhedged portion. How much is the unhedged portion here? 10,000. How much is the unhedged portion here? 5,000. Now, what is mentioned in the question is very specifically, you would use the forward rate as the best estimate of the spot. So in July, the unhedged portion would be covered at 0.950. Okay. So in USD, we are assuming that we'll have to pay $9,501 for the unhedged Canadian dollars of 10,000. So, and similarly, the unhedged portion for the 5,000 Canadian dollars in September, that we will take at what price? The forward price was 0.9556. So 5,000 into 0.9556. 4778. Now, one more thing is left. We have to pay the option fee. Okay. Uh, Regarding option premium, there's one aspect that I would like to discuss here is, so we are saying that we are going to make the payment for Canadian dollars after 1 month. And these Canadian dollars, 7,05,000 after 3 months. But is the option premium also payable after 1 month or after 3 months? The answer is no.
No.
Option premium you have to pay upfront. And it will go waste if the option is not exercised. It's a net loss. Now, when you're paying the option premium upfront, and if I add the option premium paid here, there is certain, to some extent, an anomaly. These outflows are going to happen after 1 month and after 3 months. However, the option premium is payable right now. But generally, the amount of option premium may not be too significant to make an impact of the interest cost on that. However, the best thing if you want to do is to, however, under the forward contract, there was no premium. So in forward contract, the total outflow is exactly after 1 month and exactly after 3 months. But under the option premium, the premium is payable upfront. Now, there are one best option you can do here is you can calculate the amount of premium required, and that premium can then be assumed to be borrowed. And then you can add the interest cost together with the interest cost that can be taken as an outflow. That would be when you are being perfectly diligent in your comparison. However, as interest rates are not given in this question, so a better option would be you will make a note after your final solution that the option premium would be payable upfront, though it is added in the total outflow after 1 month and 3 months. The interest cost on that is ignored, right? Okay. So finally, how much option premium we have to pay? 1.02. So on a US stock exchange, these are cents per Canadian dollars. So it's 1.02 cent. So 10 lakh, how many contracts we have taken for? 10 lakh, not for 10 lakh, 10,000. So we will multiply 10 lakh with 1.02. So we are ending up paying 10 lakh 20,000 cents, which you can definitely divide by 100. So you will get an outflow in terms of dollar. So you will end up paying 10 lakh 2,000, $10,200 as option premium. So this will be your total out. Remember to calculate the option premium only on 10 lakhs, not on 10 lakh 10,000. And remember that this is cents. Okay. So 1.02 into 10 lakh divided by 100. That would be our option premium for the July. And how much would be the option premium for September? 7 lakh multiplied by 1.64 cents. That's 5 by 100. It comes out to be 11,480. So what I want to do regarding option premium is, first point, option premium is payable upfront. You will make a footnote after your solution that interest on premium is ignored. One. Second thing, option premium has to be calculated on specific number of contracts which you have taken for the amount. Option premium will not be on 10 lakh 10,000. It will be only on the number of option contracts you have taken, 10 lakh and 7 lakh. And one more aspect you have to take care of option premium. Which currency are you making the payment? Like I said, if you have any confusion, let's say you have an option on a share of ABC Limited. So the option is on the shares of ABC Limited. Let's say strike price is 40 rupees and premium is 2 rupees. Right? This is how you look for a stock price. So similarly, the option is on Canadian dollar. The strike price is 0.94 and the premium is 1.0. So both the things will be in terms of USD, right? So 10 lakh into 1.02 cents and similarly 7 lakh into 1.64 cents. So you'll divide by 100. $1 is 100 cents, $11,480. Add the total outflow. So in July, you will end up paying 9,59,701. And in September, you will end up paying 665,000 plus 4,778 plus 11,480. 681,258. Now make a comparison. So this is perfect cover, 100% covered. Nothing is left unexposed. Nothing is left unhedged. And the outflow will be 959,601. Here the outflow would be 6,73,698. While under option cover, the outflow is slightly more, just about 100 more here and something around 8,000 more here, 8,000. So our final solution says forward cover are giving us less outflow in terms of dollar outflow, right? So we can definitely say that forward cover is better than the option cover, firstly. Secondly, there is another problem in option cover, which is that we are not completely hedged. We have left 10,000 and 5,000 uncovered. That is the second problem. So no doubt in this question, our option would be, we would recommend a forward cover to the person. Right? Any questions in this or absolutely clear? Vibhu, Leela, Sanjay, everyone?
Clear, man.
Clear, ma'am.
Presentation is also clear, how you will attempt in the exam and what footnotes you will write.
Yes, clear.
right? Once again, another small question. Okay. Before I begin with this question, uh, we have talked about, I'll take a plain slide if I can. We have talked about forward contract. All you have to take care of is one, whether bid will be applicable or ask. And secondly, the nature of the quote, whether it is a direct or indirect quote. So to make things simple, first ensure that whatever the currency you need, maybe, or whether whatever the currency you will receive. So whether you need to pay or whether you need to receive, that should be in the denominator. And then if you need to pay that, ask will be applicable. And if you need will receive that, bid will be applicable. Okay. So in forward contract, all you have to take care of is to ensure that the quote should be available for you. It should be a direct quote, and the currency in which you are going to receive or you need to pay, the foreign currency you need to pay or receive, that is in denominator. In that case, if you want to make the payment, you need ask or receive pay. So if indirect quotes are given, please properly convert it into first direct using one upon bid or one upon ask. Secondly, in futures, you will take care of number one, uh, contract size. So you not be, maybe do not get 100% hedge. Then you will take care of this thing that if you have payables, so when you make the payment, you are fearing that the currency may not rise, the price may not increase. Whatever the foreign currency you have to pay, you are just skeptical or you're apprehensive that the price of that foreign currency should not increase. So something which you are thinking will increase in future means it's available now cheap. So you will buy the futures of that currency. And if it is receivables, you are fearing the price may not fall. So you will sell the future. So just check whether the futures are available for that currency or not. So if as an Indian, I have dollar payables, I will buy dollar futures. If I have dollar receivables, I will sell dollar futures. But if the futures are on rupee, the future contracts are not on dollars, but they are on rupee, I will reverse the. So I have dollar payables, I will sell rupee futures. If I have dollar receivables, I will buy rupee futures. So be very sure what is the contract size and the futures are available on what currency. If the futures are available on home currency, you will take the opposite of these positions. If I have dollar payables, I'll buy dollar futures, but if rupee futures are available, I'll sell them. So this is one thing you have to take care in the futures. Similarly, under options, like in the previous question, I had Canadian dollars payable. So if I have payables, that means I'll need to buy that currency. So if I need to buy that currency, I need to be a buyer of call option. If I had receivables, I need to sell Canadian dollars. In order to hedge myself, I will be a buyer of put option. Here also, if the options are not available on Canadian dollars, if they were available on US dollars, I would have taken the opposite position. Under option contract to hedge, you will generally be a buyer. However, we can say that in order to avoid the cost of premium, you can buy a call option or sell a put option. So what will happen if you are a seller of a put option? The other party, if he exercises the option, he will sell you the Canadian dollars. So indirectly you will buy. So you buy a call option, or you may also be a seller of put option. But being a seller of an option is not hedging. It's taking very much risk. So, but this can be one of the things. You can also sell put option, either buy call option or sell put option. Here, either buy put option or sell a call option. Because if you sell a call option, someone else will buy the Canadian dollars. Okay. But they are not equivalent. It's not like exactly the same thing as here taking opposite position. It's very different under options. Buyer and seller are two different persons. They have different level of risk. So generally you will look from this angle, not from this, until and unless the question demands it specifically. Okay, right? Money market hedge should be very clear to you. It's a very simple concept. If you have some payables, make an arrangement that you have exactly the same receivables on the same date. Now, to have received something in future, you need to deposit to them, but deposit the present value of that. But where will that money come from to deposit it today? It will come from the spot market. So you need to see how many home currency you need to have that, and that you can borrow from the home country. So just a recap of what you have to take care if you are dealing with the options, futures, etc. Let's now look at question number 18. A Limited of UK has imported. I am very specific here. A Limited of UK has imported is another important word. Chemical is not important. For me, in this chapter, which country and whether you are an exporter or importer. So he's from UK. That means pounds are his home currency. And he is a importer, UK importer. UK importer from US. So he will have USD payables. Importer needs to make a payment, exporter gets a payment. So if you are an importer, you need to make the payment. If you are an exporter, you will receive the payment. So he will have USD payables. Now the amount. Next thing is amount. Once I have deciphered all these information, next thing is how much is the amount. So it's $364,897. And another question is 6 months. So far it is clear that what I am interested in finding is pound by USD asked after 6 months. UK importer has imported chemical worth 364,897. Another important information. USD, another important information. Payable in 6 months. So everything comes down to this line that I need the pound by USD ask after 6 months. So what's the spot rate and what's the 6 months forward? Now, whether it is pound by USD or USD by pound, how will you know? To some extent, you can also make an idea of this, that pound is premium at USD. So in one USD, you're going to get point 0.9 something, point 0.8 something pounds, point 0.6 something maybe. And in one US, if you want to have 1 pound, you will get more dollars. So this is more than one. So that means the rates given are dollar by pound. However, you cannot be having an idea of all the currencies in the world, which one is trading at premium or which one is at discount, or what are the various rates of different currencies in the world. We are okay when it comes to pound, euro, USD, Japanese yen, yuan, rupee, but Swiss franc, French franc also. Maybe we have some idea. But what if altogether different currencies of the world are used? So we'll not rely on this common sense or information that pound is more costly than the USD. So what is the spot rate? USD 1.5617 and USD 1.567. So these are the rates for 1 pound. Okay. So definitely we need to ask. So for us, the applicable rate would be this. 1 upon bid would be the ask. We need to reverse the quote. So for us, bids are applicable and not in multiplication. We can directly divide 364,897 divided by 1.5617 today. 364,897 divided by 1.5455 after 6. So we have solved our first part of the question. If forward rate is applicable, how much would be the outflow in terms of the pounds? 3,64,897 divided by 1.5455, which gives us these many pounds. All right. The borrowing rates in UK and US are also given. Borrowing rates are 7% and 6%. And deposit rates are 5%, 5.5 and 4.5%. That means somewhere it will speak about money market hedge. So before talking about the currency options, let's do some calculations for money market cover. I'll use this template here. We have a liability. How much? US dollar 364,897. So we will have to pay, let's create receivables. So to create receivables, US dollar 3,64,897. I need to deposit in US. What are the deposit rates in US? 5.5 and 4.5, UK and US respectively. In UK and US respectively. So US deposit rates are 4.5. 6 months. So to receive 3,64,897, once again, 4.5 divided by 200 plus 1, 1.0225. So you need to calculate how much you have to deposit. You have to calculate the present value of what you will need after 6 months. After 6 months, you are going to need $3,64,897. When they will be divided by 1.0225, that means you need only how many? 3,56,868. Here, when I'll round off, I will always round off to the next multiple. Okay. And I'll make a note if I am writing my exam that the figure has been rounded off to the multiples of 1 and they have not been rounded off. I have moved to the next integer or the next higher whole number, right? So mention this thing because what do we want? We don't want to be falling short of any amount. Maybe we have excess, it's okay, but we shouldn't fall short of what we are supposed to pay. So if I would invest 356,867, I might receive a little less. So when making a payment, I want at least $364,897 to be received by me. Now, I am a person who's in UK. So this is not my home currency. And I don't have $356,868 now. I have some pounds maybe, but that also I don't have. I will borrow. So $356,868 you need. And the current spot rate is 1.5617. So in order to be able to invest 356,868, I will need a little less than that. So 356,868 divided by 1.5617. That 28,500, 28,512 pounds. Once again, you can take the higher number. So you will need 2,28,513 pounds. So you will borrow this. We don't have it. If we had the money now, we could have paid right away. So we'll borrow 2,28,513 pounds in UK. And what is the borrowing rate in UK? Borrowing rates in UK is 7%. But we are not going to borrow for a year. We're going to borrow for 6 months. Okay? 7% per annum, I would write. So this is all that I have done. What I have done today is borrowed from UK 228,513 at 7% per annum, converted into dollars using spot rate. So this became 228,513 into 1.5617, which will give me 356,868 and invested dollar 356,868 in US at 4.5% per annum interest. For 6 months. So this is what I have done as a money market hedge. After 6 months. Now what happens after 6 months? I'll receive 3,64,897 dollars from deposits in US, and pay my obligation of 364,897 and repay the borrowed money of pounds 2,28,513 in UK at 7% per annum. So net outflow will be equal to 2,28,513 pounds multiplied by 1.035. So I'll have to pay 3.5% interest. So the total net outflow is 2 lakh 36,510 or 511. Once again, I'm reminding you, units are very important in exam, but particularly when you are doing a question on forex, at each step, your currency must be mentioned. So once you've completed the question, maybe you've completed it fast in a flow, just do a quick calculation, quick recheck or review whether you have marked the currencies at all relevant places or not. So the net outcome is no matter whatever the exchange fluctuation is, no matter what you pay uh, in terms of your USD dollar, whatever the exchange rate is, your outflow will be 2,36,511. Okay. So we can see under the forward cover what it would be. 1.5455. 3,64,897 divided by 1.5455. So if you had gone for a forward cover, your outflow would have been 2,36,102.87 or 100. Under the money market cover, 236,511. And last, under the currency option. So currency options are available under which one option contract is for GBP 12,005. So what is it? Currency options are available under which one option contract is for GBP 12,500. So if you want to buy or sell pounds, you can do so using the option is available on what? The option is available on pounds. This is the underlying. But we want to buy what? We want to buy dollars. We don't want to buy or sell pounds. We want to buy dollars. So if we wanted to buy pounds, we would have gone for buying a call option of pounds, right? But we want to buy dollars. So we would go buy put option, right? I remember I just spoke about this. We need what? We need dollars. So we would have gone for a call option on dollars. But option available on, so we will buy a put option if available. So if you buy a put option, what will happen? You can sell your pounds and you will get the contract size is 12,500. Option premium for pound at a strike price of USD 1.70. Great British pound is USD 0.037 under a call option and 0.096 under a put option for 6 months period. So the thing that is of interest to us is a put option. Strike price is same, that is 1.70, and premium is 0.096. So it's not in cents. Premium is straight away 0.096 USD. Okay. So what happens? You are able to sell your pounds for 1.70 USD, but uh, what is happening is you have to pay the premium. So if it is a call, you have to pay the call exercise price plus premium. But if it is a put option, you get 1.7 less 0.096, the option premium will be deducted. Just like margin, in call option, it's to be added. Put option, you will get less amount. So first, let's see how many contracts one will take. Now, how many USD do we require? 364,897. 364,897 would be divided by 1.70, the exercise price. So roughly you need 21,000, 2,14,645 pounds. Okay. We need how many USD? 3,64,897. Option is on pound. So we'll buy a put option. Strike price 1.70. Premium 0.09. So contract size is 12,500. So how many contracts we'll need to buy? First, let's calculate roughly uh, how many pounds will give us 364,897 with a strike price of 1.7. So you need how many pounds? You need actually 214,645 pounds. If you will sell at 1.7, you will end up getting 364,897. Again, if you want to round off, you can round off to next number, but because we have a contract size here of 12,500, so these many pounds, so number of contracts would be you will do this part in 3 steps. Contract size 12,500, pounds required to sell 364,897 divide by 1.7, which is equal to pounds 214,645. Then you will calculate the number of contracts. Now, I am not very keen or particular about ensuring that this rounding off is perfect or clear. So simply you can round off to the next higher number, or you can leave it the decimal fraction totally, because the main fraction that will be applicable to us is once we divide the number of pounds with the contract size. So this fraction has to be rounded off actually. So we are getting 17.1716 contracts, which means we'll go by 17 contracts. So for 17 contracts, 12,500 into 17, you'll end up how many pounds have been covered under option contract? 12,500 multiplied by 17. So, 2,12,500 pounds are covered with a strike price of 1.7. So, 2,12,500 into 1.7. These many dollars you will get if you exercise put option. $3,61,250 will come from here. Okay. So first, how many pounds you will require? 2,12,500 pounds, as well as you will have to pay a premium of 0.096. So either we can say that 1.7 minus 0.096, you will end up getting these many dollars, 1.604 into 212, or else you can calculate the premium 0.096. So 2,12,500 multiplied by 0.096. Option premium would be 20,400. Okay. Currency options are available under which one option contract is for 12,500 pounds and option premium for pound at a strike price of USD 1.70 is USD 0.037 for a call option and USD 0.096 for a put option. So we have to pay $0.096. So we have to pay this much dollars as option premium right away. But right away, if we convert it into spot rate into pounds, 1.5617. into 13,062 pounds. Okay. So your total outflow will be 2,12,500 plus 13,062. These many pounds will be your outflow. Two lakh 25,562 pounds. And you have still got only $3,61,250 only. So 364,897 minus 361,250. The remaining $3,647 will also be arranged. Once again, if spot rate is given, it's good after 6 months. But if it is not given, you may again assume the forward rate to be the applicable spot rate after 6 months. So $3,647 is still unhedged, and $3,647 divide by 1.5455. Maybe you end up getting giving 2,360 pounds for unhedged dollars. Okay. So out, sorry, total outflow would be 225,562 plus 2,360, 227,922. Option C. Okay. So have we calculated what is the outflow? 236,103, 236,511, and under the currency options likely to be 227,922. So this is the best. Okay, which of the alternative is preferable by the company? We can very clearly say the outflow in currency option is the least. See, you are selling your pounds not at 1.56 but 1.70. So 1.70 is a very high figure in comparison to 1.56. Forwards are available at 1.54 and currency is available at 1.70. So if this is available at 1.70, there is nothing like it. Okay. That means the pound is at premium and you have to pay less pounds to get the dollars. You are getting more dollars per pound. Further, the benefit in currency option is that if the pound is at further more premium, it goes to 1.75, 1.8, then also you will stand to gain far more as compared to the forward market or money market cover. So currency option is the best case here. Once again, you will write that the premium will be payable upfront, but you are ignoring the amount as would not make interest will not make much difference. So interest cost is ignored. However, here because the US and UK rates are given, you have calculated that you need a premium of 13,062 pounds. You can borrow that 13,062 pounds in UK at 7%. So 13,062 into 1.035 to be more at pair. 13,062 together with interest, it will become not 13,062 but 13,519. So around 400 increment, around 450 increase in the cost under the currency option also. Right? So even we can say that we need to pay the premium of 13,062. So borrow this 7% for 6 months. So together with interest, this will cost you 13,519. So you may increase another 450 something here. Okay. But then also, even if you add 450 something here, 228 something will be your final answer, and your currency option is still the best option. But because interest rates are given here in this question, you may choose to calculate the option premium together with interest. Specifically because it is not just 2 months, 3 months, it is 6 months. You may do that, and that would be a better alternative, right? So this is how you're going to attempt question 18. Forward cover, money market, currency. Finally, write the outcome of total outflow under all the three scenarios. And because currency is giving us the least outflow, further, there is also an option if the Great British Pound is at more premium, options will become all the more beneficial. All right. Next question is Gibraltar Limited has imported 5,000 bottles of shampoo at landed cost in Mumbai of $20 each. You have imported how much? 5,000 bottles. Landed cost in Mumbai, $20. So the invoicing is in US dollars. You have a choice to make the payment. So firstly, you have to make the calculation, pay. Company has a choice of paying for the goods immediately. So if what you do, if you make a payment immediately, or in 3 months' time. So you may make the payment immediately. How much is the invoice amount? $100,000. You may also choose to make the payment after 3 months. So if you make the payment right away, sorry, this will be in rupee. 5,000 into $20. So it will become not converted yet. 5,000 bottles multiplied by $20. So you will end up paying $1 lakh. Company has the choice of paying immediately or in 3 months' time. Clean overdraft limit of 14% per annum. Rate of interest is charged. Calculate which of the following method would be cheaper. So if you option 1, pay immediately, $1 lakh, or pay in 3 months' time with 10% per annum interest and cover the risk in forward for 3 months. Settle now at a current spot rate and pay the interest on the overdraft for 3 months. So let's say option 1, option 2 rather, first. So what is the current spot rate? 60.25 oblique 60.55. What do we need? We need the rupee by dollar hours. So how much we'll have to pay? 1 lakh into applicable rate becomes. So 1 lakh into 60.55, 60 lakhs, 55,000. So the problem is, if we want to make the payment now, we don't have it. So we borrow it and we'll compare the interest it will cost us. So borrow 60 lakh 55,000 from the bank at 14% per annum interest. Overdraft limit is 14% for how many months? For 3 months, right? So 60 lakh 50,000 Now 14% for 3 months, you can do 14 divided by 400 plus 1. So amount will be, final payment would be, or outflow after 3 months. Outflow after 3 months, 60,55,000 multiplied by 1.035. So it will be 3.5% interest for 1 quarter or 3 months. 60,55,000 into 1.0635 is 62,66,925 rupees. Okay. So this is if you go by the option 2. Settle now at current spot rate and pay interest for 3 months. You may also calculate the interest separately, 3.5% of 60,55,000 and add that to this. Now, what is the option 1? For that option 1, we need to do one more thing. We need to create a working note where we will calculate the forward rate. Forward rate after 3 months. Okay. What would be the forward rate? 35 and 25 are the swap points. They are decreasing. So what would be the forward rate? Okay. So you are going to ask, so applicable forward rate would be 60.30. But what will be the problem? If you make the payment after 3 months, the vendor will charge you 10% per annum. So it's not 1 lakh. He will charge 1 lakh plus 2.5% interest. So you'll end up paying 1 lakh plus 2.5% interest, 2,500. So 1 lakh 2,500 multiplied by 60.30. So the outcome will be 61 lakh 80,000. Okay. So what is a better option? Better is to pay the vendor after 3 months together with 10% interest and cover the US payments in the forward market because the USD is at discount. Swap points are not increasing, they're decreasing. The USD is at discount, so it will be benefit. Final answer. We'll work on this again, right? Let's move on to MCQs.
Can you explain this swap points?
Okay.
I could not understand.
Okay, I'll do that. See, there is a payment of 1 lakh US dollar to be made. No doubt about this.
No, I'm asking about you added and subtracted these swap points in the spot rate.
Okay.
When is this
All
to
right,
be
all right.
added and subtracted?
60.25 and 60.55. These are the spot rates, right? Mumbai spot rates.
Yes.
And swap points are 35/25. Now, this is the ask rate. Okay, and this is the bid rate. So if the rates increase, they will increase here also, they will increase here also. Let's say the rates have increased by 30. So technically now, if both are added, the new bid should be 60.55 and your ask should be 60.85, right? Okay, if
Yes.
swap points increased by 30 actually. But what happens is, when it comes to making the payment, they say the rates have increased, but not very much. So when the bank is making the payment to the merchant, they do increase the 30, but not too much. But when they ask from you, when they take money from you, they increase. So here they might increase by 35 because they're getting. Here they might increase by 25 because they have to give. Okay? They will not add exactly 30 on both the sides. So when they are asking money from you, they will say pay 35 more because it has increased. But when they are paying to you as a merchant, when the bank is paying to the merchant, they will also say, yes, it has increased, but it has increased by 25. Is it clear?
Yes, so it has to be
So,
decreased on
so
ask.
when the swap points are not 35, 25, it means the prices have not increased, they have decreased. So when they are decreasing, and they will be decreased from here. Okay. So 60.25 minus 35, 59.10. So when they are paying, they will decrease more. Okay.
Yes.
But when they are asking from you, they will not decrease so much. 60.30.
So swap points means always the rates have
Change.
they
The
actually
PIP,
increases.
the fix. So had it been, had it been, the swap points had they been, okay, let's say this is the question, my MCQ. The swap points are 40, 50. What would be the new forward rate? This is my
It
MCQ
would be
for today.
60.25 plus 0.40. So it will become 60.65 and 60.55 minus 0.5.
Okay.
Yes,
It will
yes.
increase at both the places. Why? Because this is in a ascending order, 40, 50. So when the prices have increased, they will increase in the bid also, in the ask also. But in ask, they will ask you more to pay more. But when they are paying, they'll not pay you so much.
So swap
Similarly, if
point,
the price have decreased, they will decrease. But the decrease in bid will be far more than the decrease in ask.
so does it mean it always increases? So if swap points is given in the question, that means these are increasing. Rates are increasing.
No. If swap points are given like 35-10, which one is bigger?
35 years.
That means decreasing. Rates have decreased. The currency is at discount. If swap points were 35-70, which one is greater?
70.
That then you have to add. Then the currency is at premium. Okay?
Okay.
If thus, firstly, swap points are given 35-25. Another thing is, another MCQ, 60.2502 oblique 60.5530. Then swap points are given 35 and 25. What would be the forward?
Yes,
It would be
60.2502 minus 35 and 60.5530 plus.
this is the indication of swap points. Since there are 4 pip, 4 decimal points, so this 35 would be added to the last two. If this has been 350, 250, it would have become 2852. Decreased by this much. Okay, sorry. Decreased by 350, 215. So first, these are up to decimal, swap points are 2 decimals. So whatever the changes are to be made, you have to add the swap points to these 2 decimals. Then you have to take care whether it is 35-25 or 35-45. So if the first one swap point is more, then you have to decrease. But if the second swap point is more, you have to add. Okay?
Yes, okay, clear. Thank you.
All right. So if we have time, let's move on to first few MCQs. Quickly, is there an arbitrage opportunity?
Yes, there is arbitrage. Opportunity is there, yes.
How?
Rates are quoted differently by two different dealers.
We have said that bid should always be less than ask. Okay. So if bid of any bank would be greater than ask of any other bank, there would be an arbitrage opportunity. Do we see an arbitrage opportunity? All right, think about it, take a note of this, and maybe we'll discuss in the next session. Okay. So
Whether
when two,
some MCQs have been left, or you will get.
yes, sir. Actually, they were asking a doubt on the previous question, so I've just taken. I've
Okay,
asked some MCQs in that question itself, but these MCQs,
okay,
yeah,
okay. So you will take up in this next
de-
class.
definitely.
I
Yes.
think you were in previous class session also some MCQ have been left.
I won't take it starting from there only today.
Okay, you are starting from there. Okay, okay, madam. Okay, so you are today your session is over now. No?
Right.
Okay, 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 student. Thank you very much. Now this session we have come to the. You have completed the madam assignment second assignment.
Almost one
Almost.
or two.
Okay, okay, no problem. So it will be continued in the next class. No?
Right.
So this assignment will be continued in the next class. So and we will also start the assignment third. That will be last assignment of this chapter. So meanwhile, you revise whatever has been discussed in the class. And if you have queries, so you can ask me over the telephone. Madam, just write down my phone number 0120-3045-956 and our email ID sfm-final @ICAI.in. Okay, thank you, ma'am. Thank you for sparing your
Thank you.
precious time and enlightening the student on this topic. So we will continue the discussion in the next class. Thank you, madam. Have a nice day.
Thank you. Thank you, everyone. Bye.
Thank you.
Thank you, ma'am. Thank you, sir. Bye, ma'am. Bye, sir.
Thank you. Thank you. Thank you. Thank you all. Session over. Thank you.